Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there, just to let me know that it is indeed working. Hope everybody's having a fantastic afternoon so far. We had a fun live trading room this morning. We got to talk a lot about different trades we have open and talked a little bit about the sentiment strategy and the COT report update. So yeah, so far so good on the week, right? COT report trades are looking decent. We'll see if those continue well. And our price action trades are looking pretty good. Obviously, we were able to close that Aussie Franc trade this morning for a plus 54 pip profit that we opened on Wednesday last week. So yeah, a lot of good stuff to start Monday. It's always fun to have a great start to the week, right? Anyway, just want to welcome everybody here. Also want to give a shout out to those of you who are new in the program. If you are new, let us know what state or what country you're from so we can welcome you here. But let's go ahead and jump into this. And actually, before I get started, I just wanted to share it. So this is our topic today. I had several people request this. They said they need some help with setting up their using the lot size calculator correctly and how to use a trailing stop. So we're gonna go through that today, and that's gonna be kind of our game plan. Real quick though, if you are new to the program and you're struggling with something else, we will have time today. This probably won't take me longer than 20 or 30 minutes to kind of get every question answered. So if you have another topic that you'd like me to cover at the end, feel free to put that in the chat box right now. There's no problem doing that. This is a very open-ended webinar. If you ever feel uncomfortable to ask questions in some of the other live trading webinars or whatever, definitely don't in this one. In this webinar, there's like definitely ask any question and don't feel hesitant to ask those questions because that's what I built this webinar for, was for you to kind of be vulnerable a little bit and ask those questions that might seem silly, but they're not. So definitely share them. Okay, before we jump into this, as always, I need to remind everybody about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is, and ultimately how that would affect your account if you were to lose money. All right, guys. So let's talk about, let's do this first. Let's do the lot size calculator and then the trailing stop, because that's kind of the sequence of things that you would do if you were trading. So obviously it's Monday. Hopefully most of you have gotten into your COT trades. If not, you can still hop into those COT trades, but we want to make sure that you know how to do this successfully. So let's start with the lot size calculator and why it's so important. So does anybody know what a lot size calculator is? Hopefully everybody does. If you don't, I'm going to explain it real quick. So a lot size calculator I started using not that long ago. I would say just 2 years ago, I started using this on every single trade setup I take. I went years and even successfully, I traded years successfully without a lot size calculator, um, but not to the extent that I wanted. And I was still having losses that I wasn't expecting and losses that I didn't really want to take when I wasn't using a lot size calculator. Okay. So what is this? And why do we use this? Well, let me first put up like an issue in the market generally so that you can understand the need behind this. So how do a lot of other people trade? A lot of people, when they go into the markets, they just kind of throw a trade out there. They'll just kind of hit the buy button or the sell button, and they maybe have a favorite lot size. Like they're like, oh, just one contract or a half a contract, or I'm just gonna do point 0.1 or whatever it's gonna be. Some people trade big lots, like 10 contracts at a time, 20 at a time, or something, and they just kind of hope for the best, maybe cross their fingers. Maybe their trading is really good. Like maybe they know the charts very well. Maybe this person knows how to trade the COT report perfectly, but they just don't use the lot size calculator, or they're reluctant to use it because they're like, well, I've gotten this far without it, so I don't actually need it, right? And I'm telling you, that's an attitude we need to curtail. We need to get rid of that attitude, and we need to develop new attitudes and new behaviors, because I'm telling you, um, ever since I started doing this, it unlocked a level of management that I wasn't aware of that I needed. So sometimes it's really good to be open to concepts that maybe we didn't understand before or didn't fully embrace. Um, at least give it some exploration, right? If you've never done this. But some of you are in my program and you've only been through my program. You've never been through somebody else's, or and I'm glad I got you first because now I can really put some good behaviors into your trading style right away. Uh, some behaviors that you're going to be so glad that you have. We really don't get worried about our risk management as much. I mean, obviously, there's always risk of losing money, right? Always, you can be wrong on a trade. I still have lots of losing trades. Every week, I take losing trades. Every week, I take winning trades too, right? So it's just the business. So, but you got to manage that, right? Imagine if you were to, change your lot size up. Let's say one trade let's say you put in, 5 contracts in, and the next trade you put in 10, and the next one you're like, oh, that trade lost at 10. That hurt. I'm going to go down to 1 contract again. If you're constantly changing your lot size just on a whim, you're not going to find success. So what ends up happening, and here's the issue, and I need to portray this issue and I need to move on. So basically, what happens is people will go on to any random currency pair or any random stock, and they'll just buy a fixed amount of shares of stock, or it's actually worse in the stock market because in the stock market, you have like the different stocks out there cost different. The prices vary a lot more than I think Forex does. So, you put in um, you just 100 shares of Apple is not the same as 100 shares of AMC or yeah, like 100 shares of Apple is not the same thing. Like what's a really expensive stock? Like, I don't know, like Apple or Amazon or Tesla. Um, you buy 100 shares of those versus 100 shares of what's a lower price stock like Ford or something like that. It's totally different. The amount of money you're spending on each one, even though it's the same amount of shares, the amount of money is so different. And that's the same thing that happens in Forex is because each currency pair is not created equal. You have some pairs that where their volatility is really low. And so you need more leverage. You need to push more money through to get the same amount of profit or loss from that currency pair. You have pairs like the pound yen. The pound yen just so happens to be the most volatile currency pair out of all 28 major currency pairs. So the pound yen naturally moves a lot during the day. It goes up, down a lot, it goes down a lot. And so you need to adjust your lot size to match the volatility, right? So if you're using a fixed contract on the pound yen and a fixed contract on the euro franc, which is the lowest out of the 20, those are the two spectrums. If you win on the euro franc, you're gonna make a lot of money because you have a huge lot size. Okay. Um, and if you lose on the pound yen, uh, and that pound yen naturally goes up or down 100 pips in a day, or 150 pips in a day and you lose on that guy, oh my gosh, that could wreck your entire account, right? You see what I'm saying? So that's the problem that we have to solve. We need to make sure that when we lose a trade, that I'm okay with fixed amount of dollars, but we have to find a way to get there, right? So the lot size calculator takes all the variables, like the currency pair variable, your account size variable, the appetite you have variable, which is the risk ratio, the variable of your stop loss, the variable of the currency you're trading in. It takes all those variables, combines it together, and makes sure that you're trading an even amount of money every single trade. That's the problem that we're solving with the lot size calculator. And I didn't realize that I needed to solve that problem a couple years ago, even though I was trading profitably. This will make you sleep so well at night. I'm telling you, it doesn't stop you from losing, but it will make you sleep well. It will also give you longevity if you want to do this 10 years from now. If your plan is to be a trader 5 years from now, 10 years from now, 20 years from now, I'm telling you, you have to use a lot size calculator. Okay, so let's move on. So how do you use this? Well, let's do an example. So you guys know I send out these signals on uh Saturday night, right? I send out some guys, sorry guys, my phone blows up. I'm just gonna put it away here. So I send these out on Saturday night, the top 6 caught trades of the week. So I've got, like for example, the pound yen has a pretty big stop loss, right? Well, why is that? It's because the ATR on the pound yen is the biggest out of all 28 currency pairs. So you've got 28 here, um, and the pound yen is the biggest, and then it's 179 pip stop loss. So if I were looking at this and I wanted to plug this in, I would search the pound yen. Okay. And then I would put in my account size, um, which is going to be, we'll just say my account is $200,000 and it can be whatever it is for you. Okay. Um, for my risk ratio, when I'm taking a trade with the COT report, I risk a little bit less than 1%, and that number is 0.75% on all prop firm accounts. If it's a personal account, I might do 1%. And one of the things I want to talk about is it worth doing like 2% or 3% per trade? And we'll have that conversation in just a moment. I'll help you have that conversation with yourself. Okay. All right. So I do 0.75%, which is pretty low, I will be honest. But the reason why we keep it that low is because you can't handle big swings on a prop firm challenge. You only get 10 or 12% max drawdown. So, if the COT report goes into a couple week losing streak and you have risk that's higher than 0.75, it's possible you could actually lose the account and get suspended from trading that account in the future. You'll lose your privileges. And we don't want that to happen, right? So yes, you could in theory risk, 1.5% and pass your challenge faster as long as you don't hit a major losing streak. Yes, you could pass your challenge quickly, but the risk of failing that challenge increases the more you increase that lot size. And at some point, there will be a losing streak insofar that you would fail the challenge at 1.5%. I have statistics in the COT report journal that can back up that statement, by the way. So far, I've never had anybody fail. I mean, it could happen, but I've never had anybody fail at the 0.75. Technically, I've never had somebody fail at 1% either, but I don't want you guys to do that because I can actually find a period of time. I could show you which period that was. It was a couple years ago, where if you had done 1%, technically there's a slight possibility you would have failed the challenge at one point at 1%. That's why we keep it 0.75. Again, not a huge return, but it's also not a huge loss. But if you think about it, you might as well protect your 200K account. Okay, now we continue on. What do we put in for pips? Well, that's easy because I give it to you right here. I just go to the Maytaf site and I find out what those pips are and I plug it in. So we'll put in 179 pips. And then if I click calculate, this is going to ensure that I only risk $1,500, which just so happens to be my risk appetite, which is 0.75%. Okay. This is how much I risk per trade on my 200K accounts, $1,500 per trade. If you look at my account history, every single loser is within like $10 of $1,500. Boom. Why? It's because I go through this process every time. I keep it laser like. Losses are the exact same. The only time I have losses I never have a loss over that. If it's ever over $1,500, it's like $1,500 and $10 or something like that. But it's never ever going to be like, oh, we're off by even $100 or 50. If I'm off by $50, I know I got an issue, right? But I'm never off by more than like 10 or $12 or something like that. I keep it laser airtight, guys. That's what this whole process is for. So yeah, when you see my loser, and that's what I'm so proud about. You might be like, you're proud of your losers? Yeah, I am. I am proud of my losers because they're intentional. they're intentional, they're normal intentional losses, right? Because I go through this process, right? I used to not be this way. Like when you'd look at my order history a couple years ago, 3 years, 4 years ago, especially 6 years ago, 5 years ago, it the losses would be all over. Like, okay, here's a minus 100 here and a minus 1800 here, and then like it's just all over the place. Who knows what I was doing? But now we just keep it super tight. So this is what does that. And then it's basically saying if I were to take this trade with 179 pips stop loss, risking $1,500, which happens to be 0.75 of 200 grand on the pound yen, you need to trade a 1.23 contract. So that's how I keep it airtight, the risk management. That's how I do it, right? Okay, that's the process. Now, if I wanted to trade something else, let's do another one. Let's say we're doing the Euro franc this week. Let's say we're trading the Euro franc, which is, like I said, out of 28 pairs, major pairs, this is the one with the least amount, like the ATR on this is really tight. It's not 179 pips, I can tell you that. It's closer to like 48. We could double check right now, but we don't need to. It's closer to 48 pips, okay? So if you're doing 48 pips, watch this change from the um what was that number? Like one contract something. Now it goes to 2.78. See that? So I just clicked recalculate, or I calculated again. Now I have a 48 pip stop loss. Same risk appetite, right? It's still $1,500 and it's still a 200K account. The variables that changed are it's a different currency pair, which subsequently has a stop loss that's more appropriate for the volatility that's associated with that given pair, right? And now you can see what's required to keep that laser tight, airtight risk management. Oh, it's 2.78. So instead of it being 1.23 like it was on the pound yen, now it's 2.78. Do you see why you can't use a fixed lot size and be profitable long term? If you really want to keep everything together, if you want to be like a real professional about how you're managing risk, you got to do this process. Okay. I know it will take you an extra 10 or 15 minutes on a Sunday, but on a Sunday night, I'm telling you, it's worth it. You'll sleep better. You'll know. I mean, it's not going to stop you from losing. This has nothing to do with the methodology of the strategy, as far as like the entry and like the why behind the COT report. This just has everything to do with making sure that there's no surprises, right? Obviously, you could wake up the next day and all 6 trades could be losing, which has happened. We've had weeks like that. And we just don't want those to be surprises. Like, I've had weeks where 5 of these 6 trades will just all lose. I mean, it doesn't happen all too often, but it has happened. And when that happens, it's not a fun loss. If you think about it though, on my account, how much money is that? So if I have a 200K account and I'm risking 0.75% per trade, um, it's just 0.75 times 6 trades. I'm risking 4.5% a week max. So in a week's time, I could never ever lose more than 4.5%, but in theory, I could. I could lose 4.5. So that's something I just want to make sure everybody's aware of. Um, when you invest in other things, you don't have this luxury of using a stop loss and managing your risk, which I think is so cool. So since we have this ability, let's use it. Let's the fact that trading allows us to manage risk, let's definitely take advantage of that, because you can't do that in your 401k. If you buy, I'm not saying you shouldn't invest in 401ks. I'm not a financial advisor, so just putting that out there. But it is true. Like if you put $10,000 in a 401k and the companies you bought in that 401k go to zero, unfortunately, you go to zero as well. There's nothing that says if these companies go down 10%, cut me off. Nothing there protects you that way. It's just if you're just whatever happens to them, and you go with the roller coaster. Which I like that. That's what I like this a lot more. Um, and I do this. I have a self-directed IRA, do the same thing. Like I much prefer controlling my retirement in something that I know I have control of, and it has a proven process behind it. Um, and some of these other things you don't actually have control. You're just trusting that those companies do well, and you're trusting that your financial advisor will keep you safe, right? And again, I'm not saying you shouldn't do that. Sometimes that's fantastic advice. In fact, I would recommend that for that type of investment. But I'm just telling you, my personal preference is to take control if you know what you're doing. Okay. All right. All right, so there's that, guys. That's how you use a lot size calculator, and that's why you need one. So the next process is actually taking the trade. So when I take these trades, I have a demo account pulled up here. We can take a trade here together. Let's go ahead and take a trade. So here's the pound yen. I've got it pulled up. Let's just go ahead and take a trade together and go through this process. So this is a 200K account. It's actually got a little more in it, but let's just say it's 200K. We're going to treat it as if it's just 200 grand. So we come over here, let's search the pound yen, um, and let's go through that process. So again, what was the recommended stop loss for the entire week? 179 pips. So we come over here, we put in 179, and we keep the risk ratio up 0.75. We click calculate. That's a 1.23 contract. So now that we know that, we can go ahead and click new order. And then I'm going to put in the volume area, which is where you put your lot size in. I'm going to put in 1.23. And then this is just a preference, guys. You don't have to do this, but one of the reasons why I put in my stop loss right away is because there are prop firms that require stop losses immediately. And if you don't, you'll get what's called a soft breach, which with most companies, you don't lose your account if you forget to put in a stop loss, but they'll close your trade out immediately. So you might as well put one in. Now, I don't I don't select my permanent stop loss right away. I'm just going to put one in so it's just there immediately. So I'm just going to pick a price, any price below the current market, and go with that. So I'm going to just say 181.020, and then I can go ahead and click buy. So I'm going to go ahead and buy at market. Okay, so this trade is now active. You can see I've got a buy going on, and with the correct lot size. Now I'm going to show you a trick that's really cool, guys. Follow me along here. You're going to love this. This is how you can double check that you're doing it right. Remember, when you look at the lot size calculator, remember how this says $1,500? Because the pips throw people off in MT4. I don't know if you knew this, but when you move this around, that's not really pips. It says pips. That's actually points. When it says 1,031 pips, that's not true. That's actually 1,000. That's actually 103 pips, 0.1. That's what that means right there. Okay. It's very misleading. Okay. I had several people text me about this yesterday, and no worries, by the way. If you text me about that on a Sunday night, no problem at all. I'm just trying to teach you beforehand so you can diagnose what's going on next time you take these trades, because MT4 is not your friend that way. So let me tell you how you can make it your friend. Look over to the left of that. Instead of looking at the pips, focus on the dollars, because aren't dollars what matter in the end? Who cares about your pips? It's all about the dollars, right? We all care about making money and managing the money we have, right? So let's just do dollars anyway. I mean, I still have to measure our performance through pips because that's how you measure performance in the Forex market. But as far as your risk management goes, you can forget about pips altogether. It's just all about your dollars at the end of the day. Okay. So when you look at the dollar here, you can see it says negative, $900, or right. Well, that's not enough risk, right? That's not enough room, because I prescribed $1,500 to this account on this trade, right? We already did that process, right? When we went over here, we prescribed $1,500 of max risk. So I can move this down actually to about 1,500, which puts us, I get it really close. It's hard to get it spot on. I mean, you can try, but I try to get it just under 1,500, which 1,487 is good. So I'm going to put it at $1,487. And that's good. Now it's ready to go. So that stop loss is in. And also, if you hover over it, you can double check. Yeah, it says, okay, minus. What that basically is saying is if this trade were to lose, you would lose I guess I would lose $1,487, which is no fun, but for this account, that's appropriate, right? We went through that process, and that's what we allocated to this trade. So if it hits your stop loss, obviously not fun, but it's within your trading plan. Okay. If you ever have a loss that's more than what you expected, then we have problems. And again, this is why we're going through these motions. Okay. So when you hover over this, you can double check. It'll say right here, $1,500, almost $1,500. And then you'll see it says 177.1. It doesn't have the point one on it, but that's basically saying it's 177 pips and a point one, which is pretty darn close to the recommended stop loss. I recommended 179, and 177. That's close enough. As long as our dollar is what we're supposed to be risking, then we're good. Okay. Now, that is usually where people mess up the most. So if that helped you, I hope it did. Um, Now you can also mess up your trailing stop. And I'm going to tell you guys, I actually messed up one of my trades yesterday, last night on one of my accounts. My pound yen trade actually hit the trailing stop early. So I actually just right after the webinar got right back into it because I messed it up. It was the first time I'd messed it up. In like 6 months. I hadn't messed up a trade in 6 months. So it happens. Like I was just going quickly last night, and when I was putting in the trailing stop, I'll show you exactly where I messed up. I'm going to show you how I messed up, and so that you can avoid it next time. So I did everything right. I put in the stop loss right. I put in my lot size calculator right. Where I messed up was the trailing stop. So how do you do that now? So what you do is you can look down in your terminal, guys, down here. If you don't have a terminal, like this is your terminal area. It shows your account history, your exposure, trades that you have open, just all kind of stuff like that. Um, your terminal you can get by clicking on this button right here. It says terminal. You can actually take it off or put it back on. If you can't see that, you can put it on by going and hovering over file. No, not file. It's view. If you go over view, click on terminal, you can put it on. You can also do Control T. There's some commands that you can use. Control T will put it on. Okay, so there's 3 different ways you can put your terminal on. And there's other cool things like your market watch list, Control M, your data window, Control D, navigators, Control N. Yeah, there's a lot of stuff. Okay. Now what do you do? So now that we have this trade open, we got to put it in the trailing stop. So what we do is we click on the trade, make sure it's blue, then right click anywhere on this trade. And then when you right click, you're going to hover up to trailing. It'll then hover or pop up this. Then you scoot over, come down to custom. Okay. Then it's going to bring up this cool window. Okay. It's just a little window. And again, very misleading and not great for traders because it's in points. We don't trade in points. We trade in pips, right, guys? So what is a point? A point is a tenth of a pip. So if you want to put in a trailing stop, let's say it's 100 pips, it's really 1,000 points because 100 pips is the same thing as 1,000 points, right? Now, what do I do, guys? I don't use a full average daily range stop loss as my trailing stop. Obviously, the daily range is our stop loss, but the trailing stop we want to have initiate a little bit faster. We want to lock in profits a little bit faster if this trade starts to go in our favor, right? So what do? So I use a half an average daily range. So if the recommendation this week was 179, I think it was 179. So 179 in the calculator is the average daily range. I divide that number by 2, which gives me 89.5. Now, you can either round this to 90 or you can just leave it as is and then you have to multiply it by 10. Why do you multiply half the average daily range by 10? It's because MT4 does it in points, not in pips. Otherwise, you'd be done. So you just multiply this number by 10, and now you get 895. So that's 895 points. It's basically saying 895 points is the same thing as saying 89 and a half pips. It's the exact same thing. So now if I come over here, instead of 89.5, which you can't even do, it doesn't even let you put point. You just put in 895 because that's the point equivalent of a half an average daily range. How did I do that again? Follow me along. So you go off of my recommendation, which I send out. It says 179. So you put in 179 in the calculator, you divide it by 2, okay? And then you just have to multiply it by 10, and that'll give you your points. So you put in 895 in here, and then you click OK, and you're done. That trade is now ready to go for the entire week. Okay, that's as simple as, I mean, I know there's some processes in between. Like you have to put in your trailing stop, you have to put in your lot size calculator, and have to put in the regular stop loss as well, and make sure that that's about $1,500 away on a 200K account, or whatever it is for you. Okay, so there are some points where you can get lost, but that's why I've got all these resources, and I like to go through this process so you guys can see this. But once that's done for all 6 trades, that the account's ready to go for the entire week. You can let it go. You can focus on whatever you got to do. If you got kids, you take care of your kids the rest of the week and let these trades just sit in the background. If you need to, if you work a job, pay the bills, that's fantastic. Keep doing that. Do the best you can until this becomes, your main source of income, just taking these 6 trades. Okay. It will take some time, right? It takes anywhere between 2 and 4 months to get funded, typically, if you're doing the 0.75% risk. And you're going to have some weeks where you lose money and some weeks where you make money, right? Okay. So that's how you set that up. And by the way, this is all recorded, so this will be posted. If you want to come back, what a lot of people do is they'll like pause the recording and rewind it, a few minutes, so that they can see that over. There's nothing wrong with doing that, by the way. I do that with stuff. Like I had to work on my car the other day, and I pull up tutorials all the time, like how to fix my car for this thing, on YouTube. And then I'll rewind and watch that guy do that thing again, and then I'm like, okay, I think I know what to do. Right? Just do the same thing if you have trouble doing that. Okay, guys, the last thing I wanted to do, unless you guys have other questions, the last thing I wanted to just discuss with you guys is how to when you guys are considering how much risk to take. Now, this is an interesting conversation because sometimes traders don't know how much to risk per trade. Okay. And that's totally okay. I want to help you have that conversation. Now, this is a little bit of a touchy subject because I'm actually not allowed to tell you what lot size to use. I'm just showing you the process of which I use to figure out my lot size and my reasonings behind it. Just because there's so many variables with regards to risk management where you could mess up, and your risk tolerance might be different than mine. You have to decide what that's going to be. But I do want to give you the best foot forward possible by showing you what I do and how I have that conversation with myself. So, kind of like I was saying earlier, when I evaluate a strategy that I'm going to be using for a prop firm challenge, the biggest thing I need to know, I don't even need to know the return of a strategy when I'm deciding between a prop firm challenge and not treating a prop firm challenge, is I need to know how much risk this is going to be. Like if I have a losing streak with a strategy, how big is that losing streak? And how deep do these losses get before I start to see profits, right? And so when you go back and look at the Cott Report journal and you look at the worst trading losses ever with the strategy, you actually have to go back. There's a period like a year and a half ago where if you had started at the worst time possible to the worst time possible, like we definitely cherry picked 2 very bad points. If you had started there and ended there, if you had risked 1% per trade, your loss would have been close to 10%. If you had picked, I mean, you just have to be so unlucky for that to happen, right? So worst point to worst point, you would have lost close to 10%, which is why I decided, okay, well, I don't want anybody to fail their challenge. So I'm going to go 0.75 because if you happen to be that unlucky duck and um, you pick the worst time to start a challenge and you go, you'd still be down for a little bit, but then you would recover from there, right? So that's why I selected 0.75% per trade when I risk on this strategy, is because just through trading this over time and through our historical results, you would never, at least so far, you would have never failed the challenge risking that per trade. Pretty cool, right? It's kind of nice to know that going into a prop firm challenge. But that, again, with that in mind, just a little disclaimer there, that doesn't mean it couldn't happen. You could definitely, something crazy could happen and the markets could really go against us. And yeah, you could lose way more than that, because I can't control that variable. I'm just going off of the variables that we do have information about. And that's why I do that number. If you're very risk off, you could do 0.5%. I will tell you, if you do that, that's only a half of a percent per trade. It could take you up to 6 months to get funded if you do that, but you're a lot safer. You're a lot safer at that amount. I had a guy get funded a couple weeks ago. He doesn't really come to the classes. No, I don't see him here, but I had a guy get funded a couple weeks ago. He was risking 1% per trade on the COT report, and he got funded in like 2 months. Okay, so he got funded way faster. But if he had hit a pretty bad losing streak, he could have lost his account. So he was a little bit edgy. I think he's back now that he's funded. I think he's like, okay, now that I'm funded, I'm just going to go 0.75. But he took a risk and it paid off, right? Um, I'm not going to stop you from doing that, but if you want to do that, go ahead. Just know it's at your own risk. Again, I'm just letting you know your options, but it's up to you. Um, I, 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 I do this, guys. Even if it's a new challenge, I still do 0.75, but it's up to you guys can decide what you want to do. Um, Okay, so other people will do like I've had people pass the with the COT report doing 1.5, but that's edgy, guys. Like, okay, think about that. You're taking 6 trades, that's 1.5 per trade times 6 trades a week, that's 9%. If every trade went to heck during the week, which happens, then you could lose up to 9% at 1.5% risk per trade. So yeah, I don't know about that. Like that you're treading on thin ice right there. So just letting you know, I think you're asking to fail if you go that high. Just letting you know right now. It in fact it will happen if you stay there. If you're just gambling it to see if you'll pass quickly in like a month or so, like it could happen. You could get funded if you hit a good month at 1.5, you'd pass in like 3 or 4 weeks. Yeah. If you hit a good month. But then you would, if you hit a bad period, you'd probably fail. Just letting you know. Um, okay. So you don't want to do that unless it's personal funds. So now that's the question I wanted to share with, that's the thing I wanted to share with you guys, and then we'll wrap up unless you guys have other questions. But when you're having that conversation, let me pull that up again. So when you're trading with personal funds, you can do things you can't do with a prop firm account. Does that mean you should? Not necessarily. It is up to you. So, as you guys know, with most of my strategies, I risk 1% per trade if it's I just keep it simple at 1% per trade if it's a personal account. So, this is money that I deposit with like forex.com or Owanda.com, and it's just my own funds. So it's up to me how I want to manage it. I'm a little bit more loose with this kind of money because I don't have that max 10% drawdown. If I lose 10%, I lose 10%, but I still have my 90. It's not like it's going to get taken away from me, right? So I risk 1% per trade. Um, and my worst drawdown with the COT report strategy was like 10%, with 1% per trade as my risk management. Now some people are like, Steve, I could 10%, like that's not too bad. Like my 401k in 2008 went down 55%. I can handle that, right? Like if that's you, and you want to risk more, like you can have that conversation with yourself. If you go to 1.5%, I guess your worst drawdown with the COT report over the last 3 years in theory would have been, hypothetically, it would have been like 15%. Um, if you risk 3% per trade, which is a lot, that 3 times 6 trades, yeah, you could lose 18% in a week if everything went bad. Um, you could have lost, I would say that would have put you at a 30% drawdown at one point with this strategy, but your returns would be 3 times what I do, right? So it's just a conversation you should have. Now, if you start risking like really insane numbers, like 5% per trade, okay, that's insane. That's just crazy. 5% times 6 trades, that's 30% risk you're risking 30% of your entire account every week at 5%. And yeah, if every trade lost, you'd only have 70% left of your account. And if you did that again, it's really hard. Plus, here's another thing that you guys should know. Just in a quick example, if you happen to lose 50% of your account, it takes 100% return to get 50% back. Okay. So hear me out on that. If you have $1,000 and you lose half of it, that's a 50% loss. Now you only have 100% of 500, which was half of your 1,000. So now you have a 50% left. In order to get your $500 back to the original $1,000, you have to double your account. So a 50%, if you lose 50% and then the next day make 50%, you're still down. You're still down $250, even though you just made 50% back. So there's this like balancing act between risking, if you start getting into those kind of dangerous levels of loss, the returns, the percent returns don't mean as much unless you get many X returns. Like you need to start hitting 200% gains at that point to really get your money back going again. Does that make sense? Um, so just because you had a 50% loss and you're like, oh, it's only 50%, which I don't know why you'd say that, but let's say you did. You now need to double your money to get just back to break even. So you don't want to get to those types of levels. And I think that's why I've selected the 1% risk per trade, is because my worst drawdown ever has been 10% at risking 1% per trade each week. And so if you lose 10%, it doesn't take 50% to get back. Um, even 10% gain, again, it's not going to get you back, but it's the way that curve works. It doesn't require the same level of return to, like, it's not as bad if you only lose 10%, but if you lose 50, it's like everything's shot at that point. Okay. That's the concept I wanted to share. So you have to balance those kinds of things. And I see a lot of traders, I've seen a lot of martingale strategies and EAs blow up in the past because they do that kind of thing. They'll have these, they'll make 200 or 300% and then they'll lose 50%, 50, 60%. And then it just takes forever just to get back to where they were again. And it just almost makes the strategy worthless at that point because they lost so much money on that one. Let me give you one last example and we'll wrap up. Sorry, I just wanted to share this. A lot of people don't know this, and I don't want to scare anybody. I'm not alluding to anything. I just want to share. It's just to show the example. In 1929, you all know about the famous stock market collapse, Great Depression. I've studied a lot about it. In 1929, it collapsed, but a lot of people don't know this. It didn't bottom out until 1931. If you had invested $10,000 at the top of 1929, let's say you had a job, a good job, you put in $10,000 in 1929 into the stock market, US stock market. By 1931, at the tip, from the tippy top of 1929 to the bottom of 1931, your $10,000 would have only been worth $1,500. Okay, I know that's kind of an extreme example, but it is an example I wanted to share. A lot of people don't know this, but it took until 1948. So it took 16 years later to get back to break even. Yeah. So like the highs of 1929 were the levels of 1948. Well, no, okay, so that's 19 years. So it took 19 years from the initial pullback collapse into to 1931. It took till 1948, so 19 years later. Just so a lot of what happened is a lot of people got so scarred from the stock market that they never invested in the stock market again. It was just like that was so terrible. I'm not going to do that. And again, I'm not trying to elude anything. I don't know the future. I'm just telling you guys like this is one of the reasons why I trade Forex the way I do. I use a lot size calculator because I don't ever want to lose 85% of my fortune, right? Like, or just the money. I'm not saying it's a fortune. I'm just trying the money that I've worked so hard to develop and save. And I want controls because of that very concept. I want something that works, gives me an edge, and I want controls because I don't personally I don't trust it. Okay. So I don't trust the system because I've seen that system fail, right? And I've seen what it can do. I know I wasn't alive during that time, but I know of people who were, and they've told me about what happened. And so it's just one of the reasons why I do this process. And I'm teaching people how to do this because I want you to be able to have the same controls. So, if you can manage your risk where the worst case scenario is like a 10% loss, whereas like everybody else's worst case scenario is like a 90%, 85% loss, and it's going to take them 18, 19 years to get their money back. You're back in business 2 weeks later, right? That's what I'm trying to say. Okay, guys, so that's my spiel for today. I hope this was helpful. Really appreciate your attendance today. I'll look for some more trades that we can take throughout this afternoon if I see them. But otherwise, I'll see you guys tomorrow in the live trading webinar. Thanks for coming.